Welcome to the Delaware Mortgage Rate Weekly Mortgage Market Update for the week of July 1st, 2013. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you your update. Well, last week was the first week we saw an improvement in Delaware mortgage rates since June 19th when Ben Bernanke made those comments that rocked the market, causing everything to sell off. So it was a good week last week for Delaware mortgage rates. If you look at the bond chart on the screen, you can see the big red candle on June 19th, big sell-off. Then the market kept selling off all the way until last week. We were able to stabilize, and then on Wednesday and Thursday we actually bounced higher, and then Friday we were able to hold those gains. So it looks like the trend of going down may have reversed. As you can see, the arrow there is going up. So what caused this big reversal in mortgage rates? Well, two things. Last week, some Fed members were trying to backtrack on comments made by Ben Bernanke that tapering could begin this year versus next year on the asset purchase program called QE3. And then also, gross domestic product GDP reading for first quarter of 2013 came out. It was supposed to be 2.4%, but actually came in lower at 1.8%. That is not good news. That shows the economy is still struggling. So mortgage bonds were able to rally on the news, and home loan rates did improve. Now, we are going to recommend floating your Delaware mortgage rate to start the week to see if we can ride this rally, to see if bonds can continue to improve, and hopefully home loan rates can start to move lower. At the worst, they actually touched 5%, which is crazy. So home loan rates have kind of moved back into the 4s, but they were in the 5s at the worst of it. So we're back into the 4s now. We are recommending floating to see where you're going to be at. Now, what is this big talk about the Federal Reserve? Federal Reserve talking about tapering its assets purchase program called QE3. That's definitely scared the market. But if you look at the big picture, in reality, for them to wind down everything they're doing is going to actually take years. Because what we have is we have $85 billion a month of right now currently purchasing new assets, bonds, treasuries. And then they're also reinvesting another $20 billion a month in principal payments on their current asset holdings of agency debt and mortgage-backed securities. So they're reinvesting that back in. So in order for the Fed to be totally done, this accommodating policy they have that's helping the economy is, number one, they have to stop $85 billion in monthly purchases, wind that all the way down to zero. Stop reinvesting the principal from the portfolio and just retain that. They also have to raise the Fed funds rate, which they've kept low to keep borrowing costs down. And then they actually have to start selling their holdings, which is over $1 trillion of agency assets and mortgage-backed securities and treasuries. When the Fed has already actually said they don't have to sell that. They can hold all of that to term. So, which means it could keep this program going indefinitely. So, big scare in the market. We think it was a big overreaction. That's why we got a correction, got some better rates. That's why we're recommending floating. Now, in the housing news, NAR, National Association of Realtors, stated pending home sales were up 6.7% in May of 2013, or up 12.1% from a year ago. And then the Case-Shiller Home Price Index was also up 12.1% from a year ago. We also saw home prices increase 2.5% from March 2013 to April 2013. So all of this means housing market's recovering, home prices are going up, and they're actually going up a lot. And that's going to create an affordability problem. Because if we look at what incomes are only going up 2%, home prices increasing 12.1%. That's going to create an affordability issue. So what does that mean for you? That means if you're looking to buy, get out there, buy now, get under contract. Lock in a low rate, get your home price locked in, and then take advantage of this appreciation. If you wait, you're going to see your purchase power, your buying power go down the more the rates and the affordability index goes down. In economic news, we saw the release of consumer confidence reading for June 2013, and it came out much better than expected at 81.4. which is the highest reading since January of 2008. Now, consumer confidence measures how optimistic or pessimistic consumers are about the economy. So consumers are definitely feeling better about the economy than they have been in a long time. And then Thursday, we also saw the release of weekly jobless report, initial jobless claims. That came out 9,000 lower from the previous week at 346,000 claims. We're still hovering around that 350,000 claims each week. That's not good news for the labor market. We've got to get that knocked way down to get people back to work. In the local news, the next free first-time homebuyer seminar is in Newark, Delaware, and that is on Saturday, July 20th from 10 a.m. to noon at the Christiana Hilton Hotel in Newark. And then the next one in Dover is Saturday, July 27th. That's at the Sheraton Dover. That's from 10 a.m. to noon as well. You can register for either event by giving us a call in the office at 302-703-0727 or online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.